minutes to join in. We thank you for being on time as well. 5 gold stars. Excellent, excellent. Hi, everybody. Welcome. Okay, let's see. So, good. And share my screen here. Okay, outstanding. So we'll give just a few more minutes for everybody to join in. Thank you guys so much for taking your afternoon to join us in this call with me, Manoj, and Steven.
Thank you.
Thank you guys.
Thank you to you, Lillian and Ravi, for setting this up. This is a great topic.
Absolutely. Yes, and many more. Yeah, we look forward to doing this for REF members and keeping the the resources and growth and learning opportunities going in person and virtually as well.
Awesome.
Yeah, we've got some big things planned. In fact, one of the concepts that we want to do is have 3 different workshops. So as we rotate, we do an introduction to REF and then have the keynote speakers where we break off into different groups. So people can choose to do at least, like 2 out of 3 workshops at each REF event. So it's very segmented and more meaningful, and especially more opportunities for leadership as well. We definitely want people to feel like they can contribute, just like Manoj and Steven are doing here today. And we're excited to accelerate those learning opportunities as well, so we can at least branch off and learn and grow together. Okay, all right. So thank you all for joining. Really glad that you're here today for the Real Estate Forum webinar on cost and tax strategy for real estate investors. My name is Lillian Powell, and I'm a part of the REF team. And at REF, our goal is simple. It's to connect, educate, and empower real estate investors, developers, builders, and industry partners so you can grow faster, protect what you've built, and create better deals together. So today's session is a perfect example of that. Why we're here is, as real estate investors, we're all trying to do 3 things: protect our profits, reduce our tax burden legally and intelligently, free up more cash so we can scale into the next property, the next project, and the next market. So segregation is one of the most powerful and underused tools to do exactly that. And so first, we have Steven Johnson from Orion Cost Segregation. And Steven is a cost segregation strategist who helps investors break down their properties into components so they can maximize accelerated depreciation. And so he'll tell you a little bit about that. And then second, we're joined by Manoj Kumar, CPA with Advanced Tax Services. And Manoj specializes in advanced tax planning in real estate investors and business owners. And his work includes strategic tax planning, bookkeeping, financial analysis, business advisory, and setup. So together, Steven and Manoj are going to bring their technical side into the real world application. And so you can see how these strategies work. We're going to go into case studies, when they make sense, and what you should be asking your CPA or your tax team after today. So let's go on ahead and turn it over to our speakers to do a walkthrough what cost segregation is, what makes sense in the process, and typical timelines. So Steven, I guess let's see. Steven, let's go first with you. And would you like me to also feature the overview? I can go on ahead and share that on my screen as well.
Yeah, that'd be great. If you could do that, that'd be fantastic.
You bet. Okay, let's see. Let me open that. Do the case study. Let's see.
If you have any challenges, I can always share it on my screen, so don't sweat it.
Sure. Let's see. Yeah, going ahead, and it's not coming up on mine right now.
So while you guys are putting that document up there, I just wanted to quickly share, like, to Lillian's point, it's like a teamwork here, like, with folks like Steve and a CPA or your accountant. It's always a teamwork, bouncing off each other and helping with the strategic planning. So just keep that in mind, that we complement each other in this kind of initiative on this powerful tool that, is available to all real estate investors. Awesome.
Thank you for sharing that, Manoj, and Lillian and Ravi and the entire team. Thank you so much for the opportunity to allow for me to share this time with the team. And we'll just jump in feet first, because I know everybody has a busy schedule and we want to make sure that we capitalize on our time together. This is what I call my one pager. Of course, it carries over to 2 pages, but at the end of the day, cost segregation is a tool for property owners of investment properties, of single-use or multi-use properties that you have in your portfolio to take advantage of tax law. And what we have found is oftentimes there's like no in between. It's either a lot about it, a little bit about it, and then there's everyone else in between. So the fact that we've been given this platform to be able to unpack this a little further is obviously something that we're very appreciative of. Just to give you a little bit of backstory about myself, I was in banking, private wealth banking, for 30 years. Operated at a very high level. Most of my clients were self-employed, and it was on a very regular basis that we continue to see bonus depreciation, 179 depreciation. And for the banking world, we were able to use that for add back. So we could add that back in for qualifying income. So I saw that for years and years and years. And whenever I knew that I was going to be preparing to retire from the finance world, I knew that I wanted to do something that was tied to that. And really, and cost segregation was something that I knew about from the early 2000s. So for 25 years, I was keenly aware of it and in tune with it. But I was waiting for the technology to really get to where I felt like that it could be adaptive, where we had our engineers that could be, where they could be more productive, because it is a very consuming process. And I'm going to share a sample report with y'all here in a second as well. The other thing that was really important was the tax relief bill in September of 2017. For those of us in the cost segregation world, as well as those that were taking advantage of depreciation and bonus depreciation, that was the big moment, because that allowed for us to take advantage of short life assets at 100% bonus depreciation. And so and that was on a step down up until this year. So it was 100% through 2022. In 2023, it was a step down to 80%. 2024, it was 60%. This year, it was 40%. So we were all looking at that going, man, we don't want this to go away. So fortunately, regardless of which side of the aisle that we were all on, the BBB tax bill that was passed in June, one of the big plays for us in our world, especially those of us that own investment properties, was that it allowed for the bonus depreciation to go back to 100%, and that was retro to January 19th of this year. So 100% into perpetuity until tax law changes again, which it will at some point. But for right now, the sun is shining on those of us in this world. How I like to explain it to my friends and to my clients is, take a commercial property, and let's take a big gorilla hand, for example. Let's take King Kong. He grabs that building, shakes it, pulls it up in the air, and turns it upside down. What I tell folks is for a visual, anything that shakes, rattles, or rolls is widely considered a short life asset. Okay, so just think about that in your mind's eye. I think that that will create a visual for you. So I just wanted to kind of touch on that. Also to let you know that we've had our firm for 3.5 years now. We do consider ourselves a boutique firm. Boutique meaning that you get the personal experience from us that you may not get from a big box cost segregation firm. And we take a lot of pride in that. Now, we do business coast to coast. We do, obviously, a lot of our business is based in Texas because we're based in Texas. But if you have commercial properties in other states or you have residential properties in other areas of the country, we can obviously take care of you coast to coast. I'd like to take a few minutes. There were some leading questions that Ravi and Lillian had asked for me to touch on. And so I've got those on my phone here. So I'd like to touch on a few of those. And then I'll share a redacted study that we have. It's actually one up in the Metroplex in the South Lake area. It's a single-use medical building that I'll screen share with you so that you can see what one of our reports would look like. But before I do that, so one of the questions was, can you explain cost segregation in simple terms and why investors should care about it? Well, I think I explained it a little bit there, but why it's so important is that if we're able to capitalize on reallocating those short life assets in your property, you're able to take the bonus depreciation on those assets now instead of them being extended out over time. So if you have a residential property, generally it's going to be 27.5-year terms. So normally, somebody might want to put their phone on mute there if they don't mind. Thank you so much. So on a residential property, 27.5 years is the traditional period of time. On a commercial property, it's 39 years. So again, the big win is if we can take a big chunk of that property, and on average, we estimate 30%. So it could be anywhere between 20 and 40% under normal circumstances. But let's just say it's 30% of the property can be a short life asset. If you have $1 million property, instead of it being $25,000 or $30,000 a year, we can stack, in this example, $300,000 of bonus depreciation in year one. So it's a big, big win for you because you can, obviously use that to reduce your tax exposure for that year, which of course I know that we'll touch on here in a minute as well. What types of properties see the largest benefit from a cost segregation study? Really, any property that is north of $300,000. And obviously we look at every scenario that comes across our desk. We have properties that are $40 and $50 million properties. But anything that we feel like that we can get you at a minimum, a 10-to-1 ratio for every dollar that you spend, if we can't save you at least $10, we're not going to do the study. Many times it's in the 20s, 30s, 100-to-1 and more, especially on the larger properties. So just about any property, as long as it qualifies, makes sense. It also says what type of property or property size does a cost seg study become financially meaningful? I think that I touched on that, but really anything that, in our opinion, saves you at least 10-to-1 on your spend. And then I'm going to walk through a study here in a second as well. And then let's see here. Can cost segregation be applied to older properties purchased several years ago? How does a look back or a catch-up study work? So what we tell folks is the tax law changed September of 2017. Historically, since the 90s, we've had windows of time where you have bonus depreciation on the short life assets, and then they may be on a step down, and then they may not even exist at all. But for us, anything that was September 2017 forward is going to be something that we're going to want to look at. If it's a smaller property, if it's something that's 300, 400, 500,000, likely if you endeavored that in 2017, 18, or 19, likely that's not going to make sense because of it being a smaller price point and we're 7 or 8 years into the straight line depreciation method, but we'll still take a look at it. And then, so just keep that in mind. Anything that maybe you have on your portfolio that you've had for several years likely is not a good candidate. But anything after that, of course, is certainly that we would want to look at, and especially anything in the last 2 to 3 to 4 years. And then it really says, under what circumstances would you not recommend cost seg to an investor? Really, that timeline is the only thing that we really look at, and then the 10-to-1 ratio minimum standard that we have at our firm. And then for developers doing ground up construction, when should they involve a cost segregation specialist? Pre-construction, post-construction, or at stabilization? Anytime along the way is a great time to engage our team, because we, let's just say it's a development that hasn't broken ground yet. Oftentimes the investor core may reach out to us and say, hey, can you run a one-pager for us so that our investor core has an idea of what their savings are going to be on a cost seg study. So I want y'all to keep that in mind, is that with my banking background, I think like a banker, but we have an engineer-based firm in our cost segregation firm. So we play both sides of that fence, and we're not talking, and what we're talking about is tax strategy to obviously benefit our clients. But I had one client, they have a multifamily project going up in Rockwall as an example, and they're a many time over cost seg study client of ours, and they had asked for us to again include that one pager so that their investors on that deal could see the benefit of that, which was really powerful. So keep that in mind. There's never a bad time to engage us when we're taking a look at the numbers for developers. I'm going to go ahead and I think everybody can see my screen. Everybody can see my screen, okay? Lillian?
I switched screen. So would you like me, are you switching it over to the case study?
Yes, I am.
Okay.
Hey, Steve, can I just share a quick thought? Great thought shared by you. I think the last comment that you just made, I wanted the audience to understand that this is, there is a strategic side to this kind of tool, right? So to Steve's point, for people who are engaged in, ground up kind of green projects and developments, should engage early. So, professionals like Steve or me, we can help you think through based on your parameters, to maximize the benefit of this tool, right? So it's kind of really important to think about that. Sorry, Steve, didn't mean to intervene.
No, please, absolutely. You're absolutely, we're in alignment on that. And that's the neat thing about, having this team on the huddle here with us, is that you're getting the perspective from me, right?
Steve, sorry to interrupt. So my thought process was just do a quick introduction about you and a quick introduction about Manoj will do his introduction. Then Lily has all our questions on behalf of REF members. So this is what I was envisioning this call. But if you think take 1 or 2 minutes time just to give an overview and let Manoj talk about from their services and how this cost segregation truly applied in a tax point of view. Then Lily has almost 22 questions that she collected from all the other REF members. We will go one by one. Then we will open the room for others to ask the questions.
Fantastic, Ravi. Absolutely. So I'll follow your lead. And you mentioned, taking maybe 1 more minute, if that's okay. So I see where Lillian is sharing her screen. So this is an actual study right here. And this is one, if you can go to page 3 for us there, Lillian. There you go. So right there at the very top, this was one that we were able to identify over $600,000 of short life assets in this property. This was one that was entered into service right at 2 years ago. So December 6th of 2023. And y'all may remember that was the first year of the step down. So they got an 80% bonus on their short life assets. Let's go to this was a 6,000 square foot single use office building. The total depreciable basis, you can see right there, just a shade under $2 million. And let's go to the next page if we could. I think I want to go ahead and slide down one more, please. There we go, right there. So this is where we can obviously just see the quick and dirty. So we were able to identify 5 years of short life assets, which equated to a little over 12% of the property, 15 years, which was over 19%. So on this one, we had almost 32% that we were able to identify of short life assets. And I'm sure there will be some questions that will come up during our Q&A part of our call. But just out of respect to Ravi's request, I'll hit pause. And Manoj, if you'd like to jump in, then I'll be quiet on this end and listen in myself.
Yeah, so Manoj, so Manoj is part of Advanced Tax Services, and Manoj is a certified public accountant specializing in real estate taxation advanced strategies for high net worth investors, business tax planning, and entity structuring. He advises investors, developers, and business owners on maximizing tax benefits through strategic planning. So the core services that he offers is advanced bookkeeping, advanced tax planning, financial analysis and forecasting, and business loans advisory, and business entity selection and incorporation. So do you want me to go on ahead and start asking some of the questions, or would you like to kind of give a little bit of an overview?
No, thanks, Lillian, for that. I just wanted to kind of share a little bit more detail about how we typically work. So my background has been working for the big four firms, PricewaterhouseCoopers and Ernst & Young. And what I basically learned in a decade over there is that, some of this knowledge is so vast and deep that one person may not be able to gather all the knowledge and be an expert on everything. So that's why kind of, we call ourselves like of a more boutique tax consulting firm. So you have a problem, you come to us, and we have the right resources, kind of our panel of resources we dig into, who are subject matter experts, to give you like a very thoughtful, deep solution. And then we will execute on that based on your requirements. So we are a local firm here based in Frisco, and we have an office in Bridgeport. So, and I know I work for some of you on the call today. So glad to be here. Thank you, Lillian. Appreciate it. Thanks, Ravi.
Absolutely. Okay, so we're gonna go on ahead and I can start asking you questions. So how does cost segregation fit into an overall tax strategy for real estate investors?
Yeah, so I think Steve has covered a lot of points about the cost segregation. So I don't want to duplicate what he just shared, and I will let him finish his questions as well, later on when you get to it. But there are few important concepts actually that I would like to highlight from a tax standpoint, right? So cost segregation is one of the few powerful tools available to real estate investors. 1031 is another one that I really like, and it's really complex. We'll come back to that later on. But there is a concept of passive loss versus active losses or non-passive losses, and it is really important for the taxpayer to understand that there are certain limitations because cost segregation may not be right for every single real estate investor. And there are ways of qualifying people to be able to get the full benefits. But there are concepts I'm sure some people may be familiar with called the real estate professional. And there are certain loopholes which can be utilized in a legal, lawful manner to get the benefits of passive losses. Because no matter what your full-time job is, whether you're in real estate business or otherwise, real estate business itself, is considered to be a passive, kind of income and loss. So just keeping that in mind, I would say that it is very important to start upfront, understanding your tax situation and making sure that cost segregation really is right for you. And that's where the partnership between Steve and I come into the picture, where Steve can do a very high level kind of overview of the property and give you an estimate at a high level without diving into the details about the potential savings. And I can tell you whether you'll be able to maximize the benefits from the cost segregation study or not. So that was just one kind of additional point to consider to Steve's point. The other one I wanted to also share is that cost segregation related benefits is basically all tax deferred, right? So I don't want anybody, a taxpayer, to feel like they have been able to pocket the benefits, and they are like, so it is not a good mechanism or tool to cash out, or take the tax benefits if you don't have the, the most tax friendly strategy in place, right? So because eventually, the depreciation, as IRS will take it back, and you will have to pay taxes on all the depreciation that you have claimed over the years. So with that in mind, the last thought I would have on this question is, that you need to have a good plan in place about getting a good ROI on your cost segregation study and the benefits you get, right? Because eventually, the life of your asset before you sell it or you move it into a 1031 exchange, you have to see how you're utilizing the savings that you got from the taxes. So that is very important actually, to get your maximize the benefit from the cost segregation. So again, this is not as easy as it sounds. So it's required some calculations, some forecasting estimations, and happy to help anybody who is thinking along those lines and don't have clarity. Over to you, Lillian.
Thank you for that thoughtful answer. So how do bonus depreciation rules currently work, and what changes should investors be aware of?
I think Steve already covered this. I will not spend too much time on that, but everybody is aware of one big, beautiful, bill act, OBBBA, and it is big and beautiful, I would say, because the bonus depreciation is back, right? So after January 19th, any assets that you place in service, and I wanted to emphasize on placed in service is a key tax concept, right? So you may have bought a property 3 years back and placed it in service, say in 2023, and you kind of wake up today after this presentation and say, dude, I want to now take the benefit of cost segregation. Can you take it? And I may be jumping around here, but I think it's relevant to understand, that it is relevant to bonus depreciation, new laws that is in effect today, that you can actually do it now on a property that was placed in service in 23. Will you get the same benefits as you would get for a property that would be placed in service after January 19th of 2025? Maybe not, because you will still be subject to the old rules on the bonus depreciation. But to answer your question, Lillian, the bonus depreciation is back. There are a lot of benefits around it, because as you do cost segregation study, you will be able to break it out. It's on the screen right now into different categories, the 5, 15, and the 27.5 for residential, and be able to, front load the depreciation kind of, benefits.
Thank you. So also, how does cost segregation affect passive and active income, and what role does the real estate professional status, REPS, play?
And this is really the crux of it, right? Because when we talk about the real benefit of cost segregation, for folks who are in the real estate business full time, it's easy for you to qualify and you are all set. But for folks who have a W-2 income and do real estate passively, or who are investors in real estate projects and get a K-1, I mean, it is important for them to understand that they are, passive investors, and their income and losses from those investments, even if they own single family rentals, is considered to be a passive kind of income and loss, right? So, and there are other tools to really qualify them to be, able to set off those passive losses against active income. One of them is actually to have a short-term rental kind of, that mostly qualifies people to be able to set off their passive losses against, regular income. The other one is obviously, as you mentioned, Lillian, it is the real estate professional status. And there are rules around that. We usually sit down with taxpayers who are on the edge or don't have the knowledge to kind of go through a question answer session, and we have our tools to make sure that they qualify as a real estate professional and be able to utilize the losses that they generate from this study, cost segregation study kind of, and that is powerful, because once you go through the analysis and you qualify yourself to be a real estate professional, you can actually set off your passive losses against your active income. So, and that actually documentation that you create, qualifying yourself to be a real estate professional, also helps you during any kind of IRS questioning or audit or queries that come in, because you can provide that document and prove that you are actually truly a real estate professional. So it's a rule set that IRS has set to qualify people to be a real estate professional. And one last thought on this topic, there are a lot of clients we have where one spouse is actually in full-time employment or is passive, but the spouse actually is either a real estate agent or is actively involved in real estate business, but they never thought about qualifying themselves as a real estate professional. So you may not know really that you may have a real estate professional in your household today and qualify to take the benefit of this cost segregation study. So that's where we kick in here and work with Steve to maximize the benefits for you guys.
Thank you. So, Steve, I'm going to ask, on average, how much tax savings do investors typically see? And what real example can you actually dive into?
The last part was what can I dive into? Can you ask that last part?
What example can you share?
Okay, so just to piggyback on what Manoj just mentioned, so I'll just create a visual. Let's say that you have $1 million property, and we have, now just keep in mind, the dirt you cannot depreciate. So in this example, let's just say it's a $1.2 million property, the dirt's $200,000, so we have $1 million worth of infrastructure and a vertical. Okay, so just as a visual, and if we can allocate 30% of that, right, then that's $300,000. And let's assume it's this year, so you get 100% bonus depreciation on that $300,000. So in the example that we just mentioned, if you are a real estate professional, or if Manoj or your CPA can feel confident in proving the fact that you have material participation in that property, whether it's marketing it, whether you're using it for your business or whatever it might be in between, let's make the assumption that you qualify for that. So if you're someone that is a high income earner, and let's just say, keep it real simple, let's say you earn $300,000 in income and you're paying taxes on that. And let's assume you're in a 32% federal tax bracket. That's $96,000 that you paid in taxes, or that you would have paid in this year or last year or the year before, for example. So in this very simple example, if you have $1 million property, you've got $300,000 to offset your $300,000 in income, then you very likely wouldn't have to pay in that $96,000 in taxes, or you can submit for the refund. Why is that so powerful and valuable? Well, that gives you $96,000 of earning power, right, to go towards the purchase of what? Your next property. So if you have a property and your lender requires 20, 25, 30% down, and it's $1 million property, you may already be halfway there on having more down payment for your next property. And then what are you going to do when you buy that next property? You're going to rinse and repeat and do a cost seg study on that one. So we can see how powerful that is, especially when we have properties that maybe have the extra comma, right? When you have the million, the 5 million, the 10 million and up, it can be very powerful.
And then thank you for that great example. So can cost segregation be applied to older properties purchased several years ago? And how does a look back or catch up study work?
Great question. And Manoj, I'll champion that because I touched on that just a little earlier, but just as a refresher, right? If we go back before September of 2017, it's likely not going to be a good candidate, right? So anything that's, let's just call it 2018 forward, but if it's a $300,000 property and you place it in service in 2018, probably not a good candidate. But if it's a $3 million property or a 4 or 5, now we might be cooking with gas, right? Because what we're going to do is we're going to run an analysis. We're going to say, okay, you've already taken this much in straight line depreciation. How much meat is still left on that bone? And can I still get you a 10-to-1 ratio? Again, so anyone that's on this call, anytime that we ever work together, if I can't get you a 10-to-1 ratio for every dollar you spend, you're getting $10 back, I'm not going to do the study, right? So hopefully that answers that question.
Yeah, so that leads me to my next question as well. So under what circumstances would you not recommend cost segregation to an investor?
Yeah, I would say that, when you have a scenario, and oftentimes what we'll have is we may have a client that has significant loss carry forwards, maybe for some other losses on sales or whatever it may be. And they may have a significant property. They may have a $2 or $3 million property. And we're like, hey, we can save you a lot of money on a cost seg. And they're like, I've got $7 million of loss carry forward. So it may not benefit them because they have so much that they're carrying forward. That's not the norm, but those are conversations that sometimes come up, and I'll be like, hey, fair enough. We'll cheer from the sidelines. And but that's one example. Another example may be someone, let's just say that they are a W-2 earner. They might be a high income earner, but they have no other passive loss on other assets. And this property may not be yielding a return, may not be yielding a profit. They may have write-offs in other areas where it's flat or it's in the red. And if they can't prove that they have material participation or that they're in real estate or that it's their business that they are running, right? For example, and that's their sticks and bricks for their business operations. If they can't prove all of that and it makes sense, then we're going to recommend, hey, this may not be the time for us to take a look at it. That said, things happen in the future, right? So if the next year they have a large event, a large cash or asset event, that might be something that we come back and revisit at a future point. But those are a couple of examples where it may not make sense.
Okay, so my next question is, for investors wanting to start today, what documents and financial information do you require to implement cost segregation properly? Just kind of jumping around a little bit, but I think that that's a good question to ask.
Absolutely. And so really it's pretty straightforward, right? So if we have somebody who says, yeah, let's move forward, what steps are next and what key items do you want from us? Oftentimes we'll ask for a copy of the closing statement from the purchase. If it's a property that they've already had on the books for a year or two or three, we'll ask for the depreciation schedule from their CPA, because that lets us know how much depreciation they've already taken. And then it also allows us to know if we're going to be the ones preparing their Form 3115. And that's the form that you file with your next return that allows for you to go back and recapture that. Then that helps us know how much depreciation you've already taken to that point. And then, if it's a commercial property, we're going to schedule, unless it's a rare occurrence, we're going to schedule our inspector to come out and inspect the property. So we prepare for that. Oftentimes on residential properties, we can find that information online through listings. Obviously, we use the Central Appraisal District. We use Google Earth. We ask for plans and specs if they have them, the appraisal if they had a lender that they worked with, surveys if they have a copy of the survey. Now, we have access to several services that we subscribe to that allow for us to get us maybe 90% of the way there. But asking for these key items helps our engineers look for the nooks and crannies and in the corners, because they're like Sherlock Holmes, right? This is like trying to, piece a piece of puzzle together, where we want to be as aggressive as possible, toe the line, don't cross it. But, as long as we can lean in and get you as much value on those short life assets as possible, everything that we get our eyes on is really key.
Thank you, Stephen. Manoj, when a property is sold, how do you handle depreciation, recapture, capital gains, and 1031 exchanges from a tax standpoint?
Yeah, Lillian, great question. I think Steve already touched upon that in some form, but I look at it, like from a three distinct kind of bucket standpoint. When you are doing a cost seg and you are actually, selling a property, right? So the three components really, if you look at it, you can break it down by what is your remaining basis in the property that you are selling, and what is the depreciation recapture, and then what is the real capital gain on the property, right? So that is like the three buckets where you don't pay any taxes on your current basis. So if you had bought a property for 100,000 and you sold it for 1.5 million, and 500,000 is your basis and 500 is your depreciation recapture. So basically on $500,000, you're not paying any taxes because that's your basis. On the 500,000 of your capital gain, depending on your tax bracket, 15 to 20%. Usually we see most of our tax clients are in 15% bracket. You pay the capital gains tax, and then the depreciation recapture comes into the play. So and that depreciation recapture now, between the real property, which is the building, you have a maximum recapture rate of 25%. Now, where the downside here is really on the personal property, depending on your tax rate, it can go up to the maximum tax bracket, right? So 37%. And that's kind of where the analysis really comes into the play. So that's really the impact of the, when the property is sold, what happens. But you have this another powerful tool, which is a little more complex than cost segregation. I would say cost segregation is made simple with professionals and experts like Steve, and with the cost segregation studies, it is a little more straightforward. It has a little more flexibility in going back in the past years and stuff like that. Where 1031 exchange, and for those of you who do not know this, is basically you can do a like kind exchange of real estate, and based on certain rule sets. It is pretty complex, I would call it. It's one of the most complex and rigid kind of rules, tax saving kind of tools, but it's great because this could set you free from any tax liability at all. So I would say 1031 is a catch all, but again, the problem is that you have to be strategic, you have to be planning in advance. That's where professionals come into the picture, where you have to have a roadmap of your real estate journey on particular investments to make sure as soon as you have the idea of buying a property to actually when you are going to sell it, you need to have that plan in place. Because the 1031 exchange, the like kind exchange, which you have to do it very timely. So you cannot sell the property, then wake up to it and say, hey, how can I save taxes? I'm sorry, you just cut my hands off, right? Because there are certain rule sets to be followed even prior to you actually selling the property. So there are certain rule sets there, but I would say 1031 is a great tool. Steve touched upon it. He used the term rinse and repeat. So you could be actually you bought a property A, you are selling it say 5 years from now, and you could be buying a property B, and you could go for a cost seg in that same year and be able to nullify the impact of depreciation recapture that same year, right? Steve, chime in. I think, if you've seen that happen, or I've seen that happen, and that's a very powerful tool. Again, as long as you plan in advance, you think through it, and there are other agencies that needs to be involved when you do a 1031 exchange to make sure that it is handled, right. And then you basically kind of, they're called the qualified intermediaries who handle, how the money is moving during the sale process, so that you can qualify under IRS to kind of be tax exempt to the extent. And again, there are rules around it. We can take that offline if anybody has that situation or has a question. Happy to answer that.
We're gonna start the Q&A here in just a second, but so from a compliance standpoint, what should investors look for when selecting a cost segregation firm? And also, like, are there any situations accelerating depreciation through cost segregation that may create a tax disadvantage?
Well, this is now you're telling me whether Steve is a qualified individual or not to hire. So putting me on the spot here, but I would say IRS is very, very clear. It's like black and white in terms of their expectations on cost segregation kind of studies, right? So as long as you've hired a professional, I was going to chime in when Steve was responding to what documentation you require. For the taxpayer, I would say the first and foremost would be a good detailed engagement letter, signed with Steve, which details, his approach, his scope, his process, and that's like an important, I would say, documentation to prove to IRS that, hey, I hired a professional, and he told me that there would be engineers and qualified people performing this detailed study, and it's not like some high level back of the envelope calculation, right? So I would say compliance standpoint, I'm trying to remember, it's called the IRS Audit Technique Guide, and there is a specific guide on cost segregation studies, and it has about, I think, 13 principal elements to kind of, qualify, the cost segregation kind of studies that are performed. So I would say, as long as you follow that process, and the studies where we are involved, we make sure that, we are making, I mean, again, I know Steve, so it's easy for me to say, hey, he's qualified, but there are, clients who have their own firms hired, and they come to us and say, hey, we are doing this, and we would kind of do some due diligence and make sure that the people hired and the approach they are taking actually, will be qualifying with IRS. And again, I would go to Steve's point, is it residential? It is commercial, and the rigor of process followed in performing the studies is really important, because if Steve came and told me, Manoj, we're going to rely on Google Earth and online information on commercial property, I would say, Steve, I mean, you're putting the client at risk here, right? So those are the things we need to think through, that, the scope of the engagement, the benefits resulting from it, and to make sure that, we are ready to respond to IRS if there is a question.
Thank you, Manoj. Well, I know that, Stephen Johnson's, extensive experience helping real estate investors and reducing tax liability and optimizing cash flow through engineering-driven costs, segregation studies. He's going to work with commercial, residential, and mixed-use properties across the United States to help any clients with those needs. So we're going to dive into the Q&A. And unless, there's any final questions that you think that, I know that there may be one or two, but I know that we want to be respectful of everybody's times. So do you all mind does anybody have any questions so far?
I see a question from Srivastav. If I can just address that quickly. His question is, if 1031 exchange can be done only once or more times. So as long as you are following the rules and you qualify, there is no limits on how many times you can do the 1031 exchange. Steve, correct me if I'm wrong, but that's what I kind of know.
Manoj, this is Prem. I have a quick question on the same topic of 1031. So, I think it is a great exchange, but at the same time, people have to be very cautious. In an LLC, if we invested as partners, is there a scope for a 1031 exchange there?
I think so. I mean, as long as your partnership structure, so there are some rules around it, Prem, and we can take the details offline. But yes, the short answer is yes. If you are making major changes to your partnership structure and stuff like that, there are some rules that we have to follow. But as far as I know, it can be done.
Thank you.
There was another question. Okay. Yeah, go on ahead and answer. Yes. Jordana?
Yes. So thank you for the opportunity. This is a very nice presentation. I am in the process
Thank
of
you.
buying one multi-family home, which is worth of $1.3 million. So now I am just asking advice for these cost segregation benefits. Do you want me close before December 31st or after January 1st? Because the seller is pressuring me to close on January 2nd, but I'm in the process of asking to close it before December 31st. What do you recommend?
Steve, any thoughts on this?
Yeah, no, I've got close on it as soon as you can before the end of the year. And why do I recommend that? If you close on it this year, then that bonus depreciation is going to go against your 2025 taxes. If you wait until January 2nd, and if you're like myself and many of our other friends on this call, oftentimes we file an extension. So I may not file my corporate returns until September and my personal returns in October. Well, if you close January 2nd, you may not be able to reap that reward until 2027, right? When you're filing your taxes for 2026. So absolutely try to close this year if you can, if at all possible. Now, that said, the seller may be pushing for January 2nd because likely their CPA or their financial advisor may be giving them tax strategy reasons on why to close on January 2nd. Makes sense? So try to dig in if you can and close this year if at all possible.
So Steve, I would just, I'm being a consultant, right? So my and I have to be careful because, our friend used the word advice. So professionally, I have to be careful. But I will share my thoughts. I can't give you advice on a live call, but I would say that, the answer is kind of subjective because we have to look at your personal or your entity's tax situation, right? Because I agree with Steve that it may be more tax advantageous for you to close before the end of this year, but depends on what your tax scenario is this year versus what you expect to be next year. It might be worthy of waiting until next year. Steve is smiling, so maybe tell me I'm wrong, Steve. But
no, I love it. I love it. And here's why I'm smiling. And everyone who's on our call, this is the perfect example why you have the two of us leading this call. Manoj, you're tax compliant. I'm a tax strategist, right?
definitely.
And so it's like the peanut butter and the chocolate when they come together. It takes both of us to work with our combined clients to give them the best advice. I'm going to call it advice or consultants. But absolutely, everyone's situation is a little different, and you do have to unpack it and go under the surface to make sure. But again, it's kind of funny. I share that our CPA friends they're our last line of defense with the IRS, and I tend to be on the front lines because I'm over there getting aggressive and trying to come up with some tax strategies to save you, keep you from having to pay more taxes than you should.
I love your analogy, though. I mean, nobody called me as sweet and delicious as you called me. So thank you.
I may not ever do it again. That's the only time
I may start charging more to my clients now.
No,
thank you.
okay, so
So
we've got a
now-
question.
So,
Oh,
Can
go
I? Okay. I think this is very good advice. I really like it, suggestion. And if I want to come to you for the more analysis, how much do you charge? I just want to know whether the cost segregation is beneficial or not based on my current situation. How much do you charge or what is the process?
Jonathan, there is no set kind of fee structure for this. This really depends on your situation, how much deeper we need to dive, what is your real scenario. So let's catch offline. I'm pretty sure, as Steve mentioned, there's a multiple of 10 to 1 when you do a cost seg study. Similarly, when you hire a professional, let's look at the cost benefit analysis of what multiple I can get you with my advice. So let's keep it offline, but yeah, really look forward to helping you here, whatever I can do for you.
Yeah. And on our end, we don't charge anything unless we have an engagement. So we're happy to run any initial analysis to make sure that the numbers work for you, and that's pro bono.
Yes, that's an advantage, Steve. Yes, at least you give them a high level number actually that they can utilize. Yeah, Prem, where you asking?
Manoj, this question is for you quickly. I will make it a complicated question, but if you can answer me. So let us say I have a triple net leasy property where I took a depreciation a few years ago and I bought, I'll throw a number, $5 million. And after 5 years, I sold it for the same $5 million to make it simple. And let us say I took a $4 million bonus depreciation, all depreciation together on year one I purchased. Now, after 5 years, I sold it for the same price. And what would be my tax burden at that point of time if I am not doing anything, no 1031 exchange, nothing? I recaptured for all that money. What would be my tax damage that year I sold?
Prem, I look smart and sharp, but I'm not that smart and sharp. Let's catch up offline, my friend. I like to make some notes, create a visual, and do some more thoughtful research to answer your question. But happy to take it offline and help you kind of think through that that scenario.
Okay, so there's been one other question in the chat. So I'm going to kind of combine these two questions. So we have somebody that sold a single family home in 2023 and bought another single family home in 2023, but did not do a 1031 exchange. And should I refine for 2023 and 2024 so that I can use the 1031 exchange and comp off the profit on my sold home? And yeah, okay.
Sorry, you
your
missed the boat. As I mentioned, the 1031 exchange requires a lot of proactive kind of measure. You cannot take any money away from the sale. It has to be planned ahead and involve the intermediary actually so that the transaction can be dealt with them. So I would try that next time. But for now, you have booked your sale. You took the money. So it's kind of now the way you did it must be right. We cannot go back and initiate a 1031. That's what I was saying in the beginning, that I like the cost segregation studies as a tool because we can go back and use the form 3115 at any particular time. The benefits may vary because, to Steve's point, if you had an asset placed in service in 2023 or 24, the bonus depreciation phase out started, but you still have some benefit you can use by filing the form 3115 in your current year, right? But then 1031 is something like, you didn't get to the airport on time and the flight just left. So unfortunately, that cannot be undone.
Is there any limit to how many times you can use it?
No, I just answered that question. So as long as you do it right, you can just keep swiping the property, as long as it qualifies and it's kind of following the rules.
Thank you for that clarification. Does anybody else have any questions so far?
Again, guys, we are a resource to you as part of the real estate forum. Ravi is big on promoting kind of, the brotherhood here, and we are always open to answering any questions and stuff. So email me or Steve, and happy to answer simple questions. If it's anything complex, specific to your scenario, we're happy to kind of, work with you on that engagement.
Yeah, and make sure that things are filed on time.
Yes, be compliant. Yes, guys.
Yes. Well, gentlemen, thank you so much for all that wonderful information. I so appreciate y'all. That was a lot of great info. Oh, we've got a hand raised. Okay, last question. Last but not least, go on ahead.
Yeah, sorry to bother you. I just want to make sure, is there any, if I close this year, is there any tax complications with respect to of property tax for the city or those kind of stuff? I need to know. Is this the right forum to ask that question?
Are you talking about the county, like property taxes on your purchase?
That's correct. Is it a prorated or they will ask for the whole year if I buy this year?
I mean, again, I'm not an expert here. Anybody dealt with this, but I kind of, my experience with the residential real estate closing, that you pay the prorated share for the day you close onwards versus the rest of the year should be paid by the seller. I don't know if that helps, but
yeah, definitely.
I would add to that, it's, on the surface, it's a nominal piece of the equation. What will happen is you will be entitled to the property on January 1 of that following year. So when the tax authority is going to recognize that sale, and that could very well trigger a re-engagement from that local CAD, the Central Appraisal District, as to what they may value that at, right? So I would say that would be the only part of the equation. If you look at what is being taxed out at now versus what you're purchasing it at, that could come into play. As we're wrapping up, Lillian, there are just a couple of small notes I'd like to touch on, just in closing on my end, if that's okay. I want to make sure, and if you can kind of scroll up on the report that you have on your screen, I want everybody to know this is probably a 70 to 80 page report. And I think after page like 15 or 16, you'll start to see the meat and potatoes of the engineered portion of the report. So this is a fully engineer-based report. We use RS means, we use the makers, we use, and you could probably keep going. And this is just some of the bullet points. While you're doing that, the other thing I want to point out is you still have the other long life assets to be able to take advantage of. So if we designate 30% as a short life asset, you still get the other 70% that you're able to write off on. These are all the photos, so it's after the photos, but this gives you a good idea. But while you're still scrolling through that, I'll finish my thoughts here. So keep in mind, there you go. And then it just goes on and on from there. So you can see all of, how this is fully engineered here. But just keep that in mind, that you still get to take advantage of depreciation on the long life assets. We just get to throw as much in that first year as possible. And then the other thing is, you're seeing our reports are audit defensible. So when if you ever go through an audit, and it's very, very, very rare for you to be audited because of a cost segregation study, the likelihood is you're being audited for another reason. And if you took advantage of a cost seg, the IRS agent may ask for a copy of your report. So what I encourage you to do when you compare us to someone else, put this in front of an IRS agent, and it's fully audit defensible, and we'll go toe to toe with them if it's ever in question. So I just wanted to mention that. And then the last thing is, everybody wins on a cost segregation study, in my humble opinion. It's a win-win-win. It's IRS tax code. It's there for a reason. Why do they allow it? Well, guess what happens when you take advantage of the savings and you get that cash flow that you didn't have before? What is a real estate investor going to do with that money? 99 times out of 100, they're going to use it to reinvest in other property. What does that do? That engages the economy. So they're pretty smart out on Capitol Hill, right? They're trying to get that money back out on the streets. So just wanted to mention that in closing. And again, thank everybody so much for including me in today's team huddle.
Likewise, thank you, Steve. Yes, absolutely. A pleasure and honor to be here, sharing the information. So look forward to connecting with you guys in live sessions.
Manoj, Stephen, thank you so much. I appreciate your insights and being the best part of REF.
Thank you. Thanks a lot. Thanks for doing
All right.
this.
Well, take care. Thank you, everyone, for joining this call.
Thank you,
Appreciate you.
everyone. Thanks
What
for
amazing
participating.
Thank you all. Thank you, Manoj. Thank you, Steven.
Thank you.